Some of you may not have. Just confirm whether you can access the financial derivatives. So generally, when you look at the definition of the derivatives, when we look at the definition of the derivative, we are simply saying that they are financial instruments. So derivatives are simply the financial instruments whose value is derived from one or more basic variables known as the assets. So those variables will either be the equity, the commodity, or the currency. Therefore, derivatives are tools to enhance investment returns and to manage the risk relative to the interest rates, exchange rates, and also the commodity prices. That's now the simple definition of the derivatives. That's now the simple definition of the derivatives. Then there are functions of the derivative. Basically, they are economic functions. Normally, they are economic functions. Number one, determining the price. Number two, to transfer the risk. Number three will be checking speculations. There is an issue on number four, so we make a correction on number four. So that number four should be that to increase the value and volume of trade. It is not the trend. We should have the trade. So to increase the value and the volume of trade by identifying the key participants of the trade. So it is not trend, but it is trend. That's now what we shall be able to see in that note number four. The number five will be encouraging entrepreneurial activities, then also to encourage savings and investments. Those are now the key uses or functions of the derivatives. Then now there are participants in the derivative markets. Number one, hedgers. Number two should be speculators and arbitrators. So down there, we start the hedgers. They are participants who enters the market to reduce the risk. Therefore, hedging is a mechanism to reduce the price risk. They are normally concerned with the savings. Then speculators, those are participants who enters the derivative market in order to make the profit. Therefore, they will be willing to accept the risk. Then arbitrators, those are speculators who are interested in the short-term gains. Therefore, making the profit out of the fluctuation of the market prices. So now the key are the types of the derivatives. Number one is options. Number two, swaps. Number three, the future contracts. And number four will be the forward contract. So we start off with the options. So we shall discuss basically the options. When it comes to the option, they are saying it is a contract which gives the buyer the right, but not the obligation to buy or sell specified assets, securities or commodities at a specified price on or before the specified future date. So the specified price is known as exercise price. So in case of the option contract, the party which has the right but not the obligation will be required to pay non-refundable commitment fee known as the premium. There are normally two types of options as follows. There is the call option and also the put option. So starting with the call option, I will be making a small notes on it in terms of the formulas, where they are saying that it is a financial contract which gives now the buyer. So call option is always about the buyer, the right, but not the obligation to acquire a given number of the securities in a future predetermined price. So I want us to make some correction in your books, how to get the value for the call option. How now to calculate the value. So value of the call option, value of the call option should be equal to maximum. Then in the brackets, market price per share. Then we minus E. E is the exercise price. Then you put there a comma, then a 0. So it should be appearing like that. So to get the value for the called option, it is simply maximum in brackets. This is the market price of the security. Then that E is the exercise price, but we put there a 0. So maximum means there is no limit upwards. Yeah, for the value for the call option, maximum means there is no limit upwards. But this 0 simply means that the minimum value for the option must be equal to 0. If you get a negative, make it to be 0, because we shall be taking the market price of the security. Then we subtract the exercise price. So maximum, there is no limit upwards. It can go to any point, but minimum should be what? At 0. So if you get a negative, make it to be equal to 0. So this 0 simply means that the minimum value for the option is 0. If you happen to get a negative, make it to be equal to 0, because it is a contract and it is an option. When you go at a loss, you pull out. But when it is a gain, you remain. So that's now the value for the call option. Then also how to get the profit or loss. So profit or loss should be equal to, profit or loss should be equal to value of the call option. Then you subtract the premium. You subtract the premium. So that's now how we'll be calculating the profit or loss. So that's now the summary of the formulas we shall be using under the call option. To get the value for the call option, maximum means there is no upper limit, but 0 means the minimum value should be 0. If you happen to get a negative, make it to be equal to 0. Then profit or loss will simply be value for the call option, you minus the premium. That's now the summary. So I will not be looking at that illustration because I will use a question from your past paper. Then the other part is the put option. The other one should be now the put option. The next one should be now the put option. So when you check in the handout about the put option, they are saying that this is an option which gives the seller the right, but not the obligation. So now you should note the difference. The call option is about the buyer. The put option is about the seller. So they are given the right, but not all the obligation to sell a specified number of the securities at some future date at a predetermined price known as the exercise price. So the option can only be exercised if the price of the security or at the expiry date is lower than the exercise price. So let us now also see how to get the value for the put option. So value of the put option should be equal to maximum. So now we reverse. We start with the exercise price. For the put option, you start with the exercise price. Then now you subtract the market price of the security. Also, it should be not be a negative. If it is a negative, you make it to be a 0. So the call option, we started with the market price minus the exercise price. But for the put option, because it is from the seller, you start the exercise price, you minus the market price. Then still also to get the profit or loss. Also to get the profit or the loss. Profit or loss will also be given by value of the put option, you minus the premium. Value of the put option, you subtract the premium. Value of the put option, you subtract the premium. So that's now the summary for that. Then the other thing, you can see some information about the option styles. When it comes to the option styles, there are basically 3 of them. The first one is the European option. So when it comes to a European option, they are saying that this gives the holder the right to buy or sell assets on the expiry date only. Therefore, the option cannot be exercised earlier. So when it comes to a European option, that the option will only be exercised at the end of the option period. There is also an American option. The option gives the holder the right, but not the obligation to buy or sell the assets on or before the expiry date. Therefore, the option can be exercised anytime between the option contract period. Hence, the option has some flexibility to the buyer or the seller concerning the debt. Then the next one, number 3, they are saying that under that option, the option can be exercised anytime before the expiry date. But the date of exercising the option is normally specified or fixed when the contract is being signed. So that's now about the 3 options. Then there is something else I want you to note down there. They have said that option can also be classified further as follows. Roman letter 1, option is in the money. So when the option is in the money, it simply means that when the option is exercised today, a profit will be realized. So if the option is in the money and you exercise it, you are going to get a gain or a profit. That's when it is in the money. The number 2 is out of the money. When it is out of the money and you exercise, you will be able to incur a loss. So those are the 2 terms. If it is in the money, there will be profit or gain. But if it is out of the money, there will be a loss. Then they have also talked about at the money. This is when if the option is exercised today, there will be no profit or loss. So those terms are normally examinable. They ask you to explain what is the option being in the money. When the option is in the money, when you exercise, you get a profit or a gain. But when it is out of the money, you will get a loss. If it is at the money, there will be no profit or loss. So that summary will enable us now to get a question in your past papers. Let us get one of the questions in your past papers in relation to that, to see how we can go about the issues to do with the options, how we can go about to deal with the issues of the option. So the first question I want us to go through, there is a question in the sitting of. There is a question in the sitting of November 2020, question number 4, part B. We can first check the question for November 2020. November 2020, question number 4, part B. November 2020. There is a question number 4, part B. November 2020, question number 4, part B. So that question 4, part B, they have given you some details that an investor has acquired a call option whose exercise price is 100. The option premium is given as 5 per option. The following are the possible market prices in shillings of the options. They have given you 114 up to 94. So when it comes to required, Roman letter 1, determine the option value based on the above market prices. So these are called options. I've shown you how to get the value for the call option. It is maximum in the brackets of market price minus what? Exercise price. Then also Roman letter 2, the profit or loss. To get the profit or loss, you simply take the value for the call option, then you subtract the premium. Then Roman letter 3, they wanted you to represent that information on the diagram, where the x-axis will have the market price and y-axis will be the option, the profit or loss for the option. Then finally, Roman letter 4, we interpret the graph. So we can start off with the Roman letter 1. So Roman letter 1 and 2 should be combined together. The Roman letter 1 and 2 should be combined together. Let us now see how to answer that part of the question. So what you should have, we can have the column for the market price of the security. Market price of the security. Then Roman letter 1 is the value of the call option, whereby I've said is given by the maximum in the brackets of the market price of the security. We subtract the exercise price. Then we have said the value cannot be negative. In case it is negative, we make it to be equal to 0. Then also profit or loss. Profit or loss. It is simply value of the call option. You subtract the premium. Value of the call option. We subtract the premium. Like that. So we simply get value for the call option. We subtract the premium. So this one is your Roman letter 1. Then this one will be your Roman letter 2. That one should be your Roman letter 2. We combine them together because it makes it easier for us now to deal with those prices. So value for the call option will be this part. Then profit or loss will now be that question. So we start off with the first price. The first price there, they have given us 114. So the first price is given as 114. So value of the call option for that case, it is maximum in brackets. So the price is 114. Confirm in the question the exercise price. Are you able to see our exercise price? How much is it in the first paragraph? 100. So this one is 100, then a 0. So when you take 114 minus 100, it will give us which here? So it will give you 14. Then we proceed to this part to get the profit or loss. So value have gotten how much? 14. The value of the call option is now this here, which is 14. Then also confirm in the first paragraph. What are you given as the premium? Yeah, so now you subtract the premium of 5 to give you the profit. So how much is that profit? Yeah, so that's now for the first price. We now go to the second price. We now go to the second price. Our second price is given as how much? We go to 112. So when it is 112, we also get there the maximum. Then it is simply take 112 minus 100 because exercise price is constant. So this will give us 12. Then profit or loss, also take 12 minus the premium, which is still 5. So that will give us a value of 7. Yeah, that's now for the second price. That's now for the second price. We go to the third price. It is 110. The next one should be 110. So also that one we take maximum, then 110 minus 100. So that price is, their value is 10. Also take 10 minus 5. We go to the next price, which is 108. The next price is meant to be 108, where you get maximum, also 108 minus 100. So is it 8? Yeah. So that's now the movement 8 minus 5, which will be 3. We go to the next price, which is 106. Also 106. Maximum 106 minus 100. So that will be 6. Then 6 minus 5. So we get 1. The next price is 105. The next price is meant to be 105. Also maximum. Then 105 minus 100. So this one should be 5. Also 5 minus 5, so we get a 0. The next price is 104. This one is 104. So it will also be maximum 104 minus 100. So this will give you 4. So this time it is a loss. We get -1. That one a loss. The next one is 102. Where you get the maximum, then 102 minus 100. So it will still be, it will also be negative. So 2 minus 5, we get -3. The next one is 100. It will also be maximum 100 minus 100. So this one will give us a 0. So whereby you get a 0 minus 5, will be -5. The next one is now 98. So 98, we have said now it is 98 minus 100. So when it is negative, we have said the minimum value, you make it 0, in case it is a negative. So this one will just be a 0. Yeah, so it will still remain -5. So the same case for 96 and 94. 96 and 94, we just do the same. Because finally they are negatives. Anything that is negative, you equate it to 0. Right. So it will simply be 0 minus 5. So also this one, we have 94 minus 100. So anything that is negative, make it a 0. So that was Roman letter 1 and Roman letter 2. So this information is for the Roman letter 1. That now is for the Roman letter 2. Now we go to the Roman letter 3, where we want to present that information now on the graph. Let us now plot the graph. They have already specified for you the graph. They are saying that in that graph, that x-axis should be representing what? Market price. Then y-axis should be the profit or the loss. So that information is already clear. So the prices are these ones. The profits or loss are these figures. So we draw them, we present them now on the graph. We present them now on the graph. We now present them on the graph. So in your graph, when it comes to the graph, we shall summarize this. So when we want to have a graph, we simplify it that way. So this side will either be the profit or the loss. Profit. Then this part will be the loss. Then these ones are the market price of the security. So the scale should come from the information that you have. The scale, we use the information that we have. So how much is the highest profit from what we have just calculated? The highest profit is 9. So this first one will be 0. So I can create a scale. So I can have 2, 4, 6, 8, and 10. Then the highest loss is how much? Negative. It's -5. So you can also have there -2, also -4, also -6. So we create our scale layout. Then the prices, we can also create a similar scale. You see the first price, the lowest price is how much? 94. Then we can have that spacing 96, 98, 100, 102, 104, 106, 108, 110, then 112, 114. So you can just have it up to 140. So those prices, you create them from the information given. We simply get them from the information that you have. Just get them from that. So we start with the first price, 94. You see when the price is 94, what was the loss? When the price was the last one that we calculated. Sorry? The loss is 5. -5. Yeah, so when it is 94, -5 is somewhere here. So you just locate that point. 94, then a loss of 5. When it was 96, it was also a loss of 5. Yeah, so you can also have 5. When it was 98, we got which here? Loss of 5. 100, we got which here? But also a loss of 5. How about 102? -3 should be in between of them. Yeah, you get at which price? 104. 104, it is which here? Negative? -1. So -1 will be somewhere up here. Then there is the one we calculate 105. So 105 is between 104 and 106. So when it was 105, what were we getting? Yeah, so 0 will appear at that point. 0 will appear at that point for 105. The next price is 106. So what are we getting for 106? 106 is 1. So you can have it at that point. Then 108. 108 is 3. Then 110. 110 is 5. 110 is 5. How about 112? 112 is 7. 12. Then 114 is what gave us 9. 114. So that graph, you just join it using the ruler. Your ruler is up. Pick up so that you can. it is linear. Mine is not on scale, but it must be linear. You use a ruler to join them. From there to there, so you use a ruler. Then from here again, when you move up, it must also be using a ruler. So if you have drawn it on scale, it will appear in that manner. When you plot it on scale, it will be able to appear in that order. So you use a ruler. We apply a ruler. So that's now the graph, but we need now to interpret that graph. So remember, it is for the buyer. The put option is the call option is about the buyer. So this one is the buyer of the call option. So this is the buyer. So the interpretation is based on at the money, in the money, or out of the money. So this zone is the loss zone. This one is the loss zone. So this level option is out of the money. Option is out of the money because you are making numbers. So this region here, option is out of the money because it's the region for the loss. All this part is the region for the loss. When you are out of, when you are making a loss, it is out of the money. Then this region, there is no profit or loss. So this region option is at the money. Option is at the money because there is no profit or loss. So at this point, the profit, the option is out of the money. There is no profit or loss. Then when it comes to this region now, this particular region. So this region, the option is in the money because you are making a profit. So this region option is in the money. Option is in the money because you are making a profit. So that's now the interpretation that you have to give in the Roman letter form. Interpretation is to show whether the option is in the money, at the money, or out of the money. In the money, it is a profit. Out of the money, it is a loss. At the money, there is no profit or loss. So that's now the interpretation. So this is for the buyer. If it could have been the seller, options are zero-sum games. The gain by the buyer will be the loss by the seller. So if it was the seller, it could have just been a reflection at that point. In a poor reflection like that. Then that is if the question have given you the seller, but now it was the buyer, it will appear in that manner. So that is now for the call option. If it were the put option, so in the car reverse, because you will draw it. If it were, this one is the call option. But if it were the put option, just a demonstration in the car. This one will go the other side. So it will be like this. Also like that. Is that enough? Yeah, you just reverse like this. If it is a put option, but the information given will enable you to get this diagram. Because for the put option, we start with exercise price minus what? The market price. But for the call option, it is the market price minus the X. So once they give you the information, that's how the diagram will appear. So that's now a summary on the information concerning the put and the call option. There is only that question I can assess in relation to that. But given any information, what you need to remember are these two formulas. This is for the call option. This one is for the put option. I've summarized those equations for you. So I want us to go back to the handout. There is that page 2. You can see that page 2 where they have said the put call parity theorem. So I want us now to check something brief on that put call parity theorem. So they are saying that it is the theory that will link the price of the call and the put option. It is a theory that will link the price of the call and the put option. Therefore, it determines the price of the call and the put option in a manner that arbitrage opportunities are eliminated. So I want us now to get that theory. So when you are using the put call parity theory, so you can just have in your exercise book as the put call parity theory. You want now to check something brief about the put call parity theory. So when it comes to the put call parity theory, I want to simplify that formula. It may not be clear for now, but it is supposed to appear like this. P should be equal to C. Then we minus PA, then plus. There is that PE. Then also there is that function, raised to the power of RT. I will explain all those terms. So the put call parity theory, we simplify it in that manner. So P should be equal to C minus PA, then there is PE, then there is that item. So where P is the price of the put option. So that P will be the price of the put option. So this particular P is the price of the put option. C is the price of the call option. So C is the price of the call option. Then this particular PA, this is the current stock price. This particular PA is the current stock price. This one is the current stock price. Then there is this one here, separate. This PE. You see this one separate. It is the exercise price. This one only is the exercise price. Then this function is on your calculator. This one here. It's the exponential constant of 1. You can see on your calculator. Just check whether you can see this function. It is exponential constant of 1. So I want us to know how to get that figure. So on your side here, invited. I'm going to write this one. So press this. Now press here. Press this function, then also press this. In a pair answer, people get the answer and the whole entire. You just press this one. See, these functions on your calculator. Then after that, you have pressed this one, then continue and also press this. Then get the answer. Shift also works. Yes. Yeah. There's some calculators which work with the shift. Then you press that one. Press shift. Yes. Shift. And then the function. Then 1. Inakuja ngapi? 2.7. 2.7. So online you are getting which figure? We require it in 4 decimal places because it is a discounting rate. We require it in 4 decimal places because it will be. So everybody can be able to see how to derive it. You may know how to get it. Yeah. It is never given in the exam, but it's there on your calculator. It will not be given in the exam. You just round it off to 4 decimal places. 2.7183. Ah.
So that is E alone or inclusive of phrase.
If signs your E, we refer to it as exponential constant. This one is the exponential constant of 1. Exponential constant of 1. So those who are online, start with the shift. Start with the shift. After you shift, now you press this sign. It is there on your calculator. After pressing that sign, continue and also press 1. Then get the answer. It should not give you an error. It should give you a figure. So those who are not getting, are you able to get that value? Kuna wale inawaka na this function. Kuna wale inawaka na hii. You can press this, then you press that function to come out automatically. But some calculators will work with the shift. So everybody is okay up to that point. So online it is now clear, isn't it? Yeah, yes.
Actually, there are 2 options.
Yes, yes.
You can use shift, then your E, then 1, you can compare. Alpha, then your E, compare bottom.
Yes, that's one. Those are the 2 separate items. Yeah. When you are using this alpha, function yes, when you are using that one, you just press this, then you get the answer. But if you are using shift, after pressing this, you also press 1 to get now the value. So that's now what we have. Then we can now continue. R is the risk-free rate. Where R is the risk-free rate. R is meant to be the risk-free rate. Then T is the time remaining to maturity. T is the time remaining to maturity, and it must be in form of the year. So that T is the time remaining to maturity, and it must be in the form of the year. So that's now what we can be able to get in that model. So now the question I would like us to go through, should be, but before we go there, kuna hiyo swali tumejibu tu saizi. This question that we have just simply done. You see the part C. Before we go back there, you see part C, they wanted you to describe 4 types of the real options available to the management when making the strategic capital budgeting decision. So we can just outline them. So one of them should be abandonment option. Number 1 will be abandonment option. You see that I'm just revising together with the part C of it. They wanted you to describe 4 types of the real option available to the investor. So number 1, we are saying abandonment option. Number 2 will be investment timing option. Investment timing option. Investment timing option. Then number 3 will be shut down option. The shut down, you close down, shut down option. The next one will be the growth option. Growth option. Growth option. So those are some of the examples of the real option that you can be able to. There are many more others, but yes, all of them are there. I've only given you 4. There is replacement. There is also the issue of redesigning option or redeploy option. All of them will work. So you only pick any of the 4. So let us now go to the question for June 2013. Question number 2, part A. June 2013, question number 2, part A. June 2013, question number 2, part A. So I will give you 5 minutes for the prayers. So those who are going for the prayers, I'll give you the 5 minutes. When we come back, now we look at the question for June 2013, question number 2, part A. June 2013, question number A.
The bottom right, now the other thing is stored.
Si wanatoshana na
Wacha kukutisa Bwana. Susa. Wacha kukutisa. Maka, kita hijack yuk. Namanya tuh time string.
The question was June 2013, question number 2, part A. So we can go through the question. So part A says that the following information relates to a call and a put option on the stock. So the following information relates to the call and the put option on the stock. So they gave us the call price is 4.50. Put price, that should be PO, not P6. So put price PO, it is 6.80. Exercise price should be XO, not X6, should be it is 70. Then current stock price SO has been given as 67.32. Then days to the option expiration is 139 days. Risk-free rate is 5%. So required, using the put call parity, determine the price of the following. So Roma letter 1 is synthetic put option. So Roma letter 2 should be synthetic call option. There is that repetition. So Roman letter 2 should be synthetic call option. Then Roman letter 3 synthetic bond. Then Roman letter 4 is the synthetic stock. So I want us to present that information as per our model, so that it looks like what we have at this level. So this is our put call parity theory. So P is the put price. So according to them, the put price is PO. According to that question, the put price is PO. Then the call price is CO. You want to make it appear like our model. Then PA is the current stock price. For them, the current stock price is what? SO. So this one is the same as SO. Then exercise price for them should be XO. We make it to be XO. So this other one, we know it is simply exponential constant of 1 and RT. So we just show it in that manner. That's now the put call parity theory. When you are using the put call parity theory, you start with the price of the put option must be equal to the price for the call option. You subtract the current stock price, then this one is the exercise price, but not by the exponential constant of 1. Then you raise the power of negative RT. So before we answer this question, always start with this part because it has 4 components. You always start with this one because it has 4 components. We refer to it as the present value of the exercise price. That part is the same as the present value of the exercise price. So always start by calculating this part because it has 4 components. It has 4 components. It is good to calculate it first. It is the same as present value of the exercise price. So our XO has been given as how much? Our XO is 70. And you remember this exponential constant of 1. We said we round it off to 4 decimal places. When you do that, it was 2.7183. So we raise to the power of negative RT. R is the risk-free rate. Are you able to see in the question the risk-free rate? They gave you which figure? So 5% is the same as 0.055. So T is the time remaining days to the option expiration they gave you in form of days. So convert it into a year. It must always be in terms of the year. So when the question gives you the number of days in a year, we use the one specified. But when it is silent, we normally assume there are 365 days in a year. So you convert that into a year. If they give you the month, divide by 12 months to convert it into a year. So this one, they gave you the number of days. So always make sure it is in terms of days. So you will round it off to 2 decimal places because all those other variables given are in 2 decimal places. You see the ones that are given? Yeah, so convert it into 2 decimal places. Express it into 2 decimal places. Should be which one? That is a very small figure. Should be closer to 70.
No,
just get the complete figure. The complete figure should be 68. So online give you your total bar that you are coming up with. When you round off to 2 decimal places, I've seen 68.68.
Yes.
So you round it off to 2 decimal places because all other variables given in the question are in 2 decimal places.
68.661.
No, we require exact figure. When you round off to 2 decimal places,
Yes.
it is 68.6168. Don't round off any, round off the final figure. Yeah, round off the final figure. It is 68.68.
Yes.
Yes. Once you get the final figure, round it off to 2 decimal places. You have to pay 68.68.
Yeah.
So now we go to the Roman letter 1. So always start with this part because it has 4 items combined. So once you get that, now you go back to the Roman letter 1. So we now go to Roman letter 1. We should now go to the Roman letter 1. So Roman letter 1, they were asking you to calculate the expected value of the put option. Expected value of the put option. So put option is the same as PO. So that means that our formula will not be affected. It is just the way it is presented. So PO is supposed to be equal to CO. We minus SO, then we add. So CO is given. What is the call price? Call price is given as what figure? 4.5. So you have 4.5. SO is also given 67.32. Then this figure is what you have just calculated, 68.68. That now will give you the value of the put option. That now should be able to give you the value of the put option. The value for the put option. $5.86. Yes. So we go to the Roman letter 2 where we have made some changes. It should be the synthetic call option. So Roman letter 2, we want to get the value of the call option. So Roman letter 2, we should come up with expected value of the call option. So Roman letter 2 should be expected value of the call option. Expected value. So that's the same as CO. So you go to our model, we make CO to be the subject. We simply go to this model. We make CO to be the subject. So making CO to be the subject, it will still remain this side, which means this one and this one will have to cross. When this cross turns out to be positive, when this cross turns out to be negative. So that means CO will be equal to PO, then plus SO minus X. So we now have it again in that manner. Remember, you use the figures given, not the calculated ones. We use, so our PO is the one given. Don't use the one that you have just calculated. Yeah. PO, you use the one that is given. So you have now calculated PO in the Roman letter 1. We don't use the calculated one. We use the ones that are given. So what is our PO? The one that is given. 6.8. So this one will be 6.8. Then SO, they have given you which figure? 67.32. Can you remember this one was 68? 68. Now comes to here. 5.44. 5.44. So now we got the Roman letter 3. So Roman letter 3 should now be the value, expected value of the bond. So that Roman letter 3 should now be the expected value of the bond. Roman letter 3, we come up with expected value of the bond. Expected value of the bond. So the expected value of the bond is what is meant to be this item here. We make it to be the subject. So expected value of the bond is this item here, present value of the exercise price. So we need to make that figure to be the subject. We make this item to be the subject. So if you make it to be the subject, this one and this one will cross, so that it remain now on this side alone. So that means that XO, when we make it to be the subject, should be equal to PO. So CO will cross, become a negative. Then the SO will cross, it becomes out positive. So you simply make that portion to be the subject. So PO, the one that is given, 6.8. 6.80. CO, it is which figure? 4.5. Then SO is which value? 67.82. 69 is a very good food. Yes. Just 9.62. So let us now go to Roman letter 4. So Roman letter 4, they were asking you to calculate the expected value of the stock. So when you are to compute expected value of the stock, so to come up with the expected value. So expected value of the stock is now the same as SO. It's the current market price of the stock. So expected value of the stock, we simply come up with the current stock price. So we make SO to be the subject. So it is the one to cross because currently it is negative. You see in our model, SO is negative. So to make it positive, it should be the one to cross. So it will be SO should be equal to CO, but PO will have to cross it. It becomes ours. So this one will just remain. That simply remain. CO was which here? It was 4.5. PO was 6.2. Remember this one was 68.68. That's now our put-call parity theory. So we just link the price of all the four components, then we come up with their respective values. So finally, there is the part B. You need now to identify any mispricing for each of the synthetic instruments. So we compare the ones that we have calculated against the one given. That's now the mispricing. So mispricing, we simply compare the current and the expected. Current is what is given, expected is what you calculated. Expected is what you actually calculated. So we shall have the column for the instrument, then current value, then expected value. Then mispricing. So mispricing is the difference between the current and the expected. So the first one is our raw material one, the put price or the put option. One is the put option. So what is the current value of the put option? 6.80. The one that you calculated in raw material one. 5.86. So get the difference to give us now the mispricing. 0.9. So that one 0.9. The next one should be the call option. So number 2 should be the call option. For the call option, the current value was which here? 4.5. So raw material 2 you calculated. You got 5.44. So that difference should be yours. Negative 0.94. You go to Roman letter 3 was the bond. So bond, you remember we started with it. Remember the present value for the exercise price that we started by calculating before we started answering the question. It was 68 point. Yeah, so that is the current value. Then Roman letter 3, you calculated the expected. 69.6. This one is what we started. Before we started answering the question, we calculated this. So the difference is which value? Negative 0.94. That's 0.94. The last one, number 4, is the stock. So for the stock is even. The current stock price is 67.32. Then the one that is expected, the one we calculated, 66. 0.3. 3.8. Your difference must also be, yeah. So those figures are the same, isn't it?
Yes.
Yeah, so whether you compute the call, the put, as long as you are using the same model, the difference will be the same. So now we can make a conclusion that mispricing will be the same. Mispricing will be the same regardless of the instrument that is used. Mispricing will be the same regardless of the instrument that is used. Mispricing will be the same regardless of the instrument that has been used. So that is now about the put-call parity theorem. That is now about the put-call parity theorem. So still on that page 2, there is that item of the option pricing model. So let us now go through that part of the option pricing model. Let us now look at the option pricing. So there are 2 of them. There is the binomial model and the black spots option valuation model. So when you go to page 2, they have mentioned that number 1 is the binomial model. Number 1 is the binomial model, where they gave you some details for that. So the model is based on the assumption that only 2 prices of the option will emerge at the expiry date of the option. So it will describe the process of the price movements, where the asset value in any time period can move to one of the 2 possible prices with their associated probabilities. So the model is based on the following assumptions. So A, a portfolio of the option and the assets are in the form of securities. B, arbitrage opportunities are not possible. Then C, there are no uncertainties in the outcome of the above portfolio. Then now I've given you this. So those steps will be understood when we do a question. So we shall be able to understand those steps when you do a question. So there is a specific question I want us to use on the binomial model. So we can have option pricing model. Number 1 is the binomial model. So option pricing model, number 1 should be the binomial model. So for that binomial model, I want us to use the question for May 2015, question number 3, part C. We use the question for May 2015, question number 3, part C. So we can check May 2015, question number 3, part C. May 2015, question number 3, part C. So I want us to go through that question 3, part C, May 2015, question number 3, part C. So there are some corrections on that question. We shall make that correction as we read the question. So the question reads that a share is currently selling at how much? 120 shillings. So there are two possible prices of the share after 1 year. 132 or 105. Change that 30 to be 105. So the question should read that a share is currently selling at 120 shillings. There are two possible prices of the share after 1 year, 132 or 105. Assume the risk-free rate of return. So you make it 9%, not 19% per annum. It is 9% per annum. It is 9% per annum. So required value of a 1 year European call option with an exercise price of 125. So they are supposed to give you 8 marks because it has 4 steps. It has 4 steps. So each one of them will be giving you 2 marks. But of course, if you don't get the first one correct, then you forget the remaining 4, the remaining 3, because it is a flow from the first one to the second one. So that's so the reason why we use binomial model is when they give you 2 prices, either this price or the other price. Once you see those 2 prices, it is directly binomial model. So the first step, we need to get the discounting rate, but that discounting rate we refer to it as the option delta. So the first step under the binomial model, we calculate the option delta. We should be calculating our step number 1. Our step 1, we simply calculate the option delta. Our step number 1, we compute the option delta. So the first step, we get the option delta. So to calculate the option delta, you get the changes. Changes in value of the option. Changes in value of the option. Changes in value of the option. And we also divide by changes in share price. Changes in share price. So when you want to calculate the option delta, we get the changes in value of the option. We divide by the changes in the share price. So this one is a call option. This one is a call option. So value for the call option, you remember. Value for the call option, it is maximum, then market price, minus the exercise price, but we say it should not be. So if it is negative, we make it what? 0. So that is now the concept. So there are 2 prices there. It is either 132 or 105. So we compute for the 2 of them. So the first one should be maximum. So that price is 132. So confirm in the question, what are we given as the exercise price? Under required, this is the value of our 1 year European call option is having an exercise price of 120. So the difference will give us which figure? It will give us 7. And then the other price, we also calculate for the other price. So the other price, I gave you 105. It could either be 132 or 105. Exercise price will still remain 125. But this one is negative. It means it becomes out a 0. So now from there you get the option delta. So from there, we simply now calculate the option delta. So changes in the value of the option, there is 7 and 0, so we get the difference. So changes, the value of the first one is 7, the one for the second one is 0. So changes in the value of the option, you get the difference between the two figures. Then changes in the share price, it is 132 minus 105. So that now should give you the option delta. Remember, you round it off to 4 decimal places because it is a discounted rate. It is a discounted rate. Option delta is a discounted rate. So you simply round it off into 4 decimal places. Just round it off into 4 decimal places. So it should give us which value? Yeah, so we should be able to come up with 0.2593. Yeah, that should be our step number 1, where you compute the option delta. So we go to the step number 2. So step 2 will be value of the portfolio. The step number 2, we should now be calculating value of the portfolio. The step number 2. So step number 2, we shall be computing the value of the portfolio. So step number 2, we calculate value of the portfolio. So to compute the value for the portfolio, you simply take present value of the share price. Present value of the share price. We subtract value of the call option. Value of the call option. So we need to compute value of the portfolio. You simply come up with the present value of the share price. You minus the value for the call option. So this region, for the present value of the share price, you simply take market price of the security multiplied by option delta, multiplied by the option delta like that. Then you subtract value of the call option. So when you want to calculate value of the portfolio, you simply come up with market price of the security multiplied by the option delta, we minus the value of the call option. So all that information should come from the step number 1. You see what we have done in step 1? Yes. So there was a price that was giving us negative, the 105. But now we only deal with the one which was giving us positive. The one which gave us positive is 132. So now we ignore 105. We only deal with 132. So this price is now 132. Then you remember the option delta, you got 0.2593. Then this value for the call option is also there in step 1. When the price was 132. What was the value for the call option? Yeah. So all these details, they come from step 1. All of them will come from the step number 1. So you ignore the negative. Now you deal with the positive price. So we get the value for that. $27.2276. So now we got the step number 3. just have them 4 decimal places. Earlier, so that we have a uniform figure. So let us now go to the step number 3. So step 3 should now be present value of the portfolio. The step number 3, you calculate present value of the portfolio. Our step number 3, yes.
Suppose in step number 1, we have a positive at this time, like for example, 1 or 5, suppose we are getting 3.
Just use the way it is, what you are getting.
See, there is another man of the mind there because of that. Suppose
it cannot be positive. It is standard measure. It is a model researched and approved.
so it is automatic that we are supposed to get
It is a model that was researched and approved. For you to use it, one must be negative, the other one must be positive. But until you start afresh, there must be a mistake somewhere. If both of them are positive, it means there is a mistake somewhere, because they are saying there must be 2 prices. One should be above the exercise price. Another one should be below the exercise price. So you see 132 is above 125. The other one must be below 125, because that is now the benchmark. And you remember what we are doing? Market price minus exercise price, or exercise price minus the market price. So they should be able to have that range. But anyway, we may have some mistakes in some cases. So in this case, it's a mistake, pick the one which is higher. If there's a mistake in the question, pick a higher positive. It will now work for us, that just in case the question has a mistake. But normally it is researched and they give you the correct figure. So now we compute present value of the, it also comes from the step number 2, where you take that value of the portfolio. Value of the portfolio multiplied by the exponential constant of 1. You raise the power of negative RT like that. So now to compute present value for the portfolio, we simply take this value of the portfolio, we discount it using the exponential constant of 1, we raise the power of negative RT. So what do we have there as the value of the portfolio in the step number 2? Sorry? 27.2276. So remember our exponential constant of 1. It was 2.7183. Yeah, so we raised the power of negative R. R is the risk-free rate. It is given as 19, but we changed it to what? 9%. So 9% the same as 0.09. So T is the time which is given under required. You can see under required. Yeah, they were asking you to get the value of 1 year. You've been called option. So T is 1 year. So T is given as 1 year. So it is coming to which year? 24 points. So finally, the step number 4. Step 4 would now be current market value of the call option. So now we go to the step number 4. So step 4 should now be the current market value of the call option. So current market value. So our step number 4 will now be current market value of the call option. So current market value for the call option, simply take present value of the current market price of the current market price of the current market price. Then you subtract the present value of the portfolio. Present value of the portfolio. So when you want to compute the current market value of the call option, you simply come up with present value of the current market price multiplied by present value for the portfolio. So present value of the portfolio is your step number 3. But now, present value of the current market price, anything to do with the present value for the market price, simply take that current market price of the share. You always multiply by the option delta. Option delta like that. Then now you subtract that present value of the portfolio. So to compute what is supposed to be the present value for the current market price, simply take the, so in that question they have said the share is currently selling at how much? In the first paragraph. Yeah, so they have stated that the share is currently selling at 120. It is there in the first paragraph. You see it. The share is currently selling at, yeah, so the current market price is 120. Then the step number 1, you had calculated the option delta. Option delta was which one? 0.2593. Then this one is your step number 3. You got which figure in step 3? 24.8841. Yeah, so that's now what will give you the value for the call option. That is what is meant to be here. The value for the call option. So there was a similar question of that type in December 2021. So I just want to take you through, then you will attempt it. Just want to take you through, check. Just a minute. The one for the exam for December 2021. The one for the exam for December 2021. There is a question number 1, part C. The one for the exam, not the pilot paper. December 2021, there are 2 of them. There is one for the exam and the pilot paper. So when you check the one for the pilot paper, question number 1, part C. Question 1, part C. December 2021, question 1C. There are 2 Decembers 2021, the pilot and the exam. So we use the one for the exam, not the one for the pilot paper. So are you able to see? So I'm only taking you through so that now you can try. So that question reads that XYZ Limited shares are currently selling at how much? At 10. Yet we go 120. Then the share price will increase by 5 or reduce by 5%. So this one they have not given, but you calculate those prices. So if it increased by 5%, get 105% of the 10 shares. So they are saying it will increase by 5%. So if it increased by 5%, get 105% of the 10. That will give us which here. Itakuwa 10.5 or reduced by what percent? So that is the same as 95%. 95% of 10. 9.5. So those are now the two prices. So there is 10.5 or 9.5. Then they continue to say that risk-free rate of return is what percent? 6%. And the strike price is the same as the exercise price, where they gave us also 10. The option will be exercised after how long? So T will be 6/12 because it is in terms of the month. Then required using a risk neutral approach, determine the value of put option. Now it is not the call option, it is the put option. The only difference is that part of the option delta. Remember the value for the put option. So when you are computing the value for the put option, value for the put option will be maximum. So this time you start with the exercise price. Then you minus market price. So that's the only difference. The rest now will be the same like what we have done. So it makes sense now from that point. Sure. Yeah. So when we meet on Wednesday, tutaangalia black and Scots. Yeah. So I'm giving you time to read more what you have done. And yeah, what I'm doing is clear because we are just doing something. If you get time like 2 hours and repeat what you have done, it will make a sense from there. Rather than leaving them out, then you'll part as well happen. So it will be unfair. So the best thing is for us just to finish that discussion on that paper. So let us meet also on Wednesday and see whether we shall finish it. Then you can revise it. Because I know every sitting, they must test you on that portion. And it is an average of at least 15 marks. Last sitting, question 3. Last sitting, question 3, part D. It was black and Scots. Yeah. Sasa tutaiacha, lazima tuielewe. Then also question 1. Also question 4. Question 4, there is a part question 4, not question 4. There's somewhere they were able to ask you to calculate the values, the exchange rates. There's somewhere for the exchange rates. So I will finish it, then also check some few questions on the exchange rate before we conclude it. So we can stop there for now. The issue should not, that delta, don't put it as negative. We're only interested in the changes. When you are looking for the changes, you start with the one which is higher. We remember it is the changes in value for the call option and the changes in the share price. So you just look at the difference. Don't put there a negative, just look at the changes. Then you use the delta in that manner. A discounting rate can never be negative. You see the figures we normally get from the table. They are always positive. So the delta cannot be negative. We just get the changes. You start with the one which is higher, you subtract the lower. So we can stop there for now.